you're just getting started with investing or you've been at it for a while and want to fine-tune your strategy, this video is going to walk you through exactly how to choose the right index funds in 3 simple steps. We're going to start by explaining what index funds actually are, especially if you're not 100% sure yet. And then we'll break down step 1, determining your investment objective and focus. Step 2, selecting the index you want to track. And step 3, looking at the specific selection criteria to choose between funds. All right, let's dive in. First, let's quickly recap what index funds actually are. An index fund is a type of investment fund that aims to mirror the performance of a particular market index. You might have heard of indexes like the S&P 500 in the US or the FTSE All-World Index, which covers global stocks. So, what is an index? Well, think of it like a list, a curated list of stocks that tracks how a particular segment of the stock market is performing. For example, the S&P 500 includes 500 of the largest publicly traded companies in the US. If the index goes up, it means that on average, those companies are performing well. If it goes down, their overall performance is declining. So when you invest in an index fund, you're not picking individual stocks. You're investing in everything on that list in the same proportion as the index. And because of that, index funds can give you exposure to hundreds, sometimes even thousands of companies, all in one go. That broad exposure is one reason why index funds are such a popular option for long-term investors. You're spreading your risk across lots of different businesses and industries. And because they're not actively managed by someone trying to beat the market, they usually come with much lower fees than traditional mutual funds. Now, some index funds also come in the form of what's called ETFs, which stands for exchange-traded funds. Like index funds, ETFs aim to replicate the performance of a specific index, whether that's a broad market index, a specific sector like tech or healthcare, a commodity like gold, or even a particular asset class like bonds. But here's the key difference. ETFs are traded on stock exchanges, just like individual stocks. So unlike traditional index funds, which are only priced once a day, ETFs can be bought or sold throughout the trading day and market prices. That means they give investors a bit more flexibility, particularly if you like to be a little more hands-on. All right, with that foundation in place, let's now move into the 3 steps you can follow to choose the right index fund. Step 1. Determine your investment focus. Before you even start comparing different index funds, the first, and arguably the most important step, is to get clear on your investment focus. This means taking the time to define what kind of investments you actually want to make. That might sound basic, but it's something that a lot of people skip. And then they end up feeling overwhelmed when they're faced with hundreds of different options. So what does investment focus mean? Well, it could include several different things. One is the type of assets you want to invest in. For example, stocks, bonds, real estate, or even commodities like gold. The other is the geographic region that you want to focus on. Maybe you want exposure to the US or the UK, or perhaps emerging markets. And finally, you could choose to focus on specific industries or themes that you care about, like technology, healthcare, sustainability, or clean energy. Some people want a fund that includes the whole global market. Others might prefer something focused, like tech stocks in the US or dividend-paying companies in the UK. Whatever it is, this first step is about narrowing your scope. Once you've clarified the kind of exposure you want, whether that's asset class, location, or theme, it becomes so much easier to find an index and eventually a fund that actually matches your goals. So don't skip this part. Even if it takes a bit of time to think through, it will save you loads of time and confusion later on. Step 2. Select the index you want to track. Once you've clarified your investment focus, the next step is to select the actual index that reflects that focus. As we mentioned earlier, an index is just a list of companies that represents a specific slice of the stock market. So your job here is to find the index that best reflects the asset class, geographic region, or theme you're interested in. Let's look at some popular examples to bring this to life. The S&P 500 index tracks 500 of the largest companies in the US across many different sectors. The FTSE 100 index is made up of the 100 most valuable companies listed in the UK. The FTSE All-World Index tracks medium and large companies from around the world across both developed and emerging markets. It's considered a global index and covers over 95% of the total global stock market. The MSCI All Country World Index, or ACWI, is similar to the FTSE All World Index and tracks medium and large companies worldwide, but has slightly fewer companies. It only covers 85% of the global stock market. Then you've got indexes like the MSCI Emerging Markets Index, which focuses on companies based in developing countries. And you even have the FTSE All World ex-US Index, which does the same thing as the FTSE All World Index, but excludes companies based in the US. So how do you choose which one's right for you? Well, there are three key factors to think about here: asset class, geographic focus, and relevance to your investment goals. Let's start with asset class. This is all about what types of investments you want exposure to: stocks, bonds, real estate, or commodities. Each of these has different indexes associated with it. If you want to invest in US stocks, for instance, you might look at the S&P 500 or the Dow Jones Industrial Average. If you're interested in bonds, you'd be looking at bond indexes instead, like the Bloomberg Global Aggregate Bond Index, which covers government and corporate bonds from across the world. Next up, geographic focus. Do you want exposure to your home market, like UK stocks, for example? Do you want to invest globally? Or maybe you're interested in specific regions like emerging markets or the US. Let's break down a few scenarios. If you're focused on UK stocks, the FTSE 100 or the FTSE 250 could be relevant. If you want global exposure, you might consider something like the FTSE All World or the MSCI All Country World Index. If you want to target emerging markets, then the MSCI Emerging Markets Index would be worth looking into. Now, something important to be aware of here is what's called home bias. This is where investors naturally favor companies based in their own country, often because they feel more familiar or safer. But research shows that this bias can actually concentrate your risk and limit your diversification. If something goes wrong in your home economy, your whole portfolio could take a hit. That's why many experts recommend including global exposure in your portfolio, even if most of your daily life takes place in one country. So it's just something to be mindful of when deciding how much of your portfolio to allocate to your home market versus the wider world. And finally, relevance to your goals. This is where you ask yourself, what am I actually trying to achieve with my investments? Are you aiming for long-term growth, income, or are you more focused on preserving capital? Your answer will help guide which index might be the best fit. Let's go through a few examples. If you're looking for long-term growth, you might lean towards broader indexes like the S&P 500 or FTSE All World, since they include large, well-established companies with long-term potential. If your goal is income, you might want indexes that focus on dividend-paying stocks. For example, the FTSE 100 includes many companies with a history of paying dividends. If you're looking to preserve capital, you might turn to bond indexes instead. While they're not risk-free, bonds are generally seen as less volatile than stocks and may help to reduce risk, especially as you approach retirement. Again, this is not an exhaustive list, but it should give you a clear framework for narrowing down which index is most appropriate for your situation. Before we jump into step 3, just a quick heads up. If you're finding this helpful and want to go deeper, our investing roadmap is opening for enrollment again at the end of May. This is a step-by-step framework that will take you from beginner to confident investor in just 6 weeks while providing you with direct support from us. We only open it a few times a year and spots usually fill up quickly. If you'd like to be the first to hear when doors open, you can join the waitlist using the link in the description. You'll get early access before it goes live to the public. Alright, now step 3. Look at the selection criteria for index funds and ETFs. Okay, so now you've identified your investment focus and you've selected the index that you want to track. You're not done quite yet. Sorry. Because there are still lots of different index funds and ETFs that track the same index. For example, if you search for the S&P 500 on an investing platform, you'll see dozens of options come up. That's where this final step comes in, choosing the actual fund or ETF that fits you best. And to do that, here are the main selection criteria to consider. The first is charges. These are the fees you'll pay to invest in the fund, and they can have a big impact on your long-term returns. The most common cost is the expense ratio. This is usually shown as a percentage, for example, 0.15%. That may not sound like much, but over 10, 20, or 30 years, higher fees can significantly reduce your returns. To find this, you can check the fund's fact sheet or its key information document. You can also just search the name of the fund plus expense ratio on Google, which is, to be honest, what I do. According to unbiased.co.uk, the average index fund expense ratio is around 0.15%, though it can vary depending on what the fund tracks. The second thing to look at is performance. This is about how closely the fund has tracked its index in the past. Ideally, you want a fund whose performance closely mirrors the index, with minimal difference. You can check this by looking at the performance section of the key information document or fact sheet. If the fund's returns are consistently much lower than the index, that's a red flag. The third thing is sustainability. If you're someone who values ethical or socially responsible investing, this is worth considering. Look for index funds or ETFs that incorporate ESG criteria. That stands for environmental, social, and governance. There are lots of ESG-focused versions of popular indexes these days, and they usually filter out companies involved in things like fossil fuels, weapons, or unethical labor practices. The fourth thing is replication method. This one gets a bit more technical, but it's helpful to understand. Index funds and ETFs can use different replication methods to track their index. One is full physical replication. This means the fund buys every single stock in the index in the same proportions. It's simple and transparent, but can be more expensive to manage, so it might come with a higher fee. The second one is sampling. The fund holds a representative sample of stocks from the index, not all of them. This is often used when the index has thousands of holdings, making it more efficient. The third is synthetic replication. The fund uses financial instruments like swaps to mirror the index's return, but without actually owning the stocks. This can introduce a different type of risk. Most large providers, such as Vanguard, tend to use full physical replication, especially for major indexes like the S&P 500. The fifth thing to consider is income treatment. This is about how the fund handles dividends. Some funds are accumulating, which means that dividends are automatically reinvested back into the fund. Others are distributing, which means that dividends are paid out to you, usually on a quarterly or annual basis. Choose the one that suits your needs. If you're in the wealth building stage and don't need the income, accumulating funds can be convenient. If you're looking to generate income, distributing funds may be better. Either way, just remember, dividend income may be taxed unless you're investing through a tax-efficient account. In the UK, this can be a stocks and shares ISA or a pension. That's actually a great tip. Make sure you use a tax-advantaged account so that you don't have to worry about taxes on your gains or dividends. Number 6 on the list is the fund provider. This one's a bit subjective, but many people feel more confident choosing funds from well-known established providers. Some of the biggest names include Vanguard, BlackRock, also known for their iShares ETFs, Fidelity, Invesco, Spider, by State Street Global Advisors, Amundi, and UBS. You don't have to stick with these, but they've built strong reputations over time, and that can offer peace of mind. Okay, the seventh thing to consider is the fund's domicile or the registered location. This refers to where the fund is legally based, and it can have implications for taxation and regulation. Now, we're not registered tax professionals, so we won't get into the details of tax treatment here, but we have linked in the description a really helpful article below from justetf.com that explains how ETFs are taxed in the UK and what to watch out for. Again, you don't need to worry about a lot of the different taxes mentioned in the article if you invest through a tax-efficient account like a stocks and shares ISA or a pension, like we do. So that would be my biggest tip for you to save you a lot of headaches. One thing we will mention is something called UCITS, which stands for Undertakings for Collective Investment in Transferable Securities. That's a European regulatory standard designed to protect investors. If a fund or ETF has UCITS in its name, it means that it meets certain regulatory safeguards, and most UCITS funds are available for UK investors as well. Also, if you want a bit more info on our favorite types of funds, global funds, including some examples, you can get a free copy of our global funds cheat sheet through the link in the description. Alright, let's do a quick recap of everything we covered. To choose the right index fund or ETF, 1. Determine your investment focus. What asset class, geography, industry, or theme are you interested in? 2. Select the index that reflects that focus, whether it is the S&P 500, FTSE 100, FTSE All World, or another one. 3. Evaluate the fund itself based on charges, performance, sustainability, replication method, income treatment, fund provider, and fund domicile. And that's it, the full 3-step process for choosing the right index fund or ETF for your portfolio. We know this was a lot of information, so if you need to rewatch, pause, or take notes, absolutely do. The goal is not to get everything perfect right away. It's to build your confidence and knowledge bit by bit. If you found this helpful, please give it a like and subscribe. It helps the channel grow and helps more people learn how to invest with confidence. Thanks so much for watching, and we'll see you in the next one.